Welcome to Compasscope. Our research platform covers over 1,100 public companies. Each week, we share one of our active research files here in dialogue format.
Every day, millions of people drop off a prescription at their local pharmacy, or maybe they mail in an order, and they just expect a pill bottle to magically appear 15 minutes or a few days later.
Right, it's just expected.
Yeah, totally. We tend to think the really hard part of healthcare is inventing the drug in a lab, but the real miracle, and frankly, the $300 billion business, is the invisible plumbing that actually gets it to you.
Oh, absolutely.
Right.
It is this staggering logistical feat that we completely take it for granted.
Yeah.
We rarely stop to consider the sheer complexity required to safely move, temperature-sensitive, highly regulated chemicals all the way from a manufacturing plant right into a patient's hand, and to do it without fail every single day.
And that invisible plumbing is exactly what we are exploring in today's deep dive. We're looking at one of the absolute most powerful intermediaries in the global pharmaceutical supply chain. It's a company called Cencora.
Yep, Cencora.
And for those of you tracking the markets at home, that is ticker symbol COR. To really break this all down, we are drawing on a really comprehensive new research report by Compasscope.
It's a great report.
It is, and we're cross-referencing that with the actual transcript from Cencora's Q2 2026 earnings call, which was back in May 2026.
The scale in these documents, it's almost difficult to wrap your head around. We're talking about a company that single-handedly manages about a third of all U.S. healthcare distribution.
A third. Just massive. So we have a lot of ground to cover today. We are going to unpack Cencora's actual business lines, stack them up against their few but mighty competitors, and examine their playbook for growth.
Right, and the risks, too.
Exactly. Look at the very real execution risks that could trip them up, dive into the somewhat weird paradox of their latest quarterly results, and finally give you an exact checklist of what to monitor going forward.
Sounds like a plan.
So let's start with the core engine. If I look at Cencora on paper, what exactly are they doing day to day?
Well, at its most fundamental level, Cencora's primary role is U.S. pharmaceutical distribution. They are the essential middleman, basically, between the manufacturer who makes the drug and the pharmacy that dispenses it.
Okay.
So they handle branded prescription drugs, generics, and even over-the-counter medications. And their network relies on feeding these massive retail chains, like Walgreens.
Right.
As well as major mail-order operations like Express Scripts, independent local pharmacies, and sprawling hospital systems.
Okay, let's unpack this a bit. So they are basically the FedEx of pharmaceuticals. They just pick up pallets of pills from the drug makers and drop them off at the pharmacy loading dock.
That is the physical foundation of the business, yeah.
Okay.
But if you only view them as a logistics company, you kind of miss how they actually generate their profits. A really critical piece of their financial engine is their relationship with Walgreens.
How so?
Well, it isn't your traditional supplier-to-customer dynamic. Cencora actually has a joint generic procurement venture with Walgreens.
Wait, meaning they team up, pool their money, and basically buy generics together?
Precisely. By aggregating their immense combined buying power, they can walk up to generic drug manufacturers and demand, frankly, significantly better buy-side discounts.
Okay, I want to make sure I understand the economics there, though. Because generics are cheap, right? Branded drugs are the ones that cost thousands of dollars. Why focus the massive joint venture on the cheap stuff?
It's all because of the margin structure of the pharmaceutical industry.
Right.
Manufacturers of those really expensive, patented, branded drugs, well, they hold all the pricing power.
Yeah.
You basically just tell the distributor, hey, we will pay you a tiny flat fee to move this box.
Because they have a monopoly on that specific drug.
Exactly.
Mm-hmm.
But with generics, there are multiple manufacturers making the exact same chemical compound. They are aggressively competing for shelf space.
Oh, I see.
So Cencora can say, look, we represent Walgreens and a third of the U.S. market. If you want us to buy your generic blood pressure pill instead of your competitors, you need to give us a massive discount. So Cencora buys it super cheap, sells it to the pharmacy at the standard rate, and they just keep the spread.
Ugh.
Generics actually make up the vast majority of the gross profit for wholesalers.
Wow, okay. So they are using their logistical network like FedEx, but they're leveraging their scale to enforce Costco-style bulk discounts on the supply side.
That's a perfect way to look at it.
That makes total sense. But they don't just do U.S. pills, right? Because the Compasscope report highlights an international segment and something called World Courier.
Yeah, the International Healthcare Solutions segment. This includes Alliance Healthcare, which handles European pharmaceutical distribution. But World Courier, that is where the complexity really scales up.
Really?
Yeah, that is their global specialty logistics arm. So imagine a newly developed cell or gene therapy.
Okay.
These are often custom-made for a specific patient. They require strict, continuous time and temperature-controlled cold chain shipments.
Right, like liquid nitrogen stuff.
Exactly. If the temperature fluctuates by even a few degrees, $1 million life-saving treatment is completely ruined. So World Courier handles that incredibly high-stakes, high-value logistics.
Man, which is just a totally different universe than dropping off a pallet of aspirin at a CVS.
Oh, entirely different.
And it seems like that specialty focus ties directly into another division I really wanted to ask you about. Their specialty pharmaceuticals division and these management services organizations, or MSOs.
Yes. This is perhaps the most crucial part of their entire evolution. Through these MSOs, Cencora completely transcends being just a distributor.
How do you mean?
Well, they actually own groups like RCA, which is Retina Consultants of America and OneOncology. Cencora essentially owns and runs the back office operations for specialized doctors.
Wait, they run the doctor's office?
Yeah, they handle the practice management, the billing, revenue cycles, administrative support. They even integrate clinical trials into the local practices.
Wow. This is where I start to really see the bigger picture here. They aren't just moving boxes for these doctors. They are essentially running the business infrastructure for the clinics that prescribe the most ultra-expensive specialty drugs on the market.
Exactly. It embeds Cencora directly into the healthcare delivery system itself.
Right.
I mean, think about it. If Cencora runs the back office, Cencora ensures that the high-margin specialty drugs flow specifically through their own distribution network. It is a brilliant pull-through strategy.
That is wild.
And they are so committed to this human specialty focus, that they are actively shedding other massive businesses.
Like what?
Well, right now, they are in the process of merging their MWI Animal Health division with Covitrus just to get it off their books. And they've already divested their U.S. hub consulting services.
So if they're shedding literally hundreds of millions in animal health revenue just to build this impenetrable fortress around human specialty care, who is actually capable of competing with them?
Good question. They operate in what is effectively a three-player oligopoly.
Yeah.
Cencora, McKesson, and Cardinal Health. Those three collectively control over 90% of the U.S. pharmaceutical distribution market.
90%.
Yeah. And Cencora alone, like we mentioned, handles roughly $300 billion flowing through their systems annually.
Okay, let me push back on that market dominance for a second, though.
Sure.
The Compascope report states that Walgreens accounts for about 25% of Cencora's total sales. Express Scripts is another 13%.
Right.
If there are only three big players to choose from, and Cencora relies on just two companies for almost 40% of its revenue, doesn't that make them incredibly vulnerable? I mean, what stops Walgreens from waking up tomorrow and just moving to McKesson?
It is the most obvious risk when you look at it on paper, but you really have to look at the moat Cencora has built. The switching costs in this industry are just astronomically high.
Like software lock-in.
Oh, beyond that. These aren't just handshake delivery contracts. They are deeply embedded IT and operational systems. Cencora provides the ordering software, the inventory management, the daily delivery routing.
Okay, so it's like trying to change the entire foundation of your house while you're still living inside it. You'd basically have to shut down the pharmacy to rip out all that software.
Precisely. And remember that joint generic procurement venture we just discussed earlier?
The Costco discount thing?
Exactly. That makes Walgreens financially dependent on Cencora's purchasing power. If Walgreens leaves, they lose the massive bulk discount that they built together. So it is this mutually dependent lock-in that makes switching incredibly painful.
I see. Okay, but beyond just locking in their customers, there's a financial metric in the report that really jumped out at me.
Which one?
It said Cencora operates with a sustained negative cash conversion cycle of about negative 10 days.
Yeah.
Hold on, negative 10 days. Are you saying drug manufacturers are just totally fine letting Cencora hold on to their cash for a week and a half without charging any interest? How on earth did they get away with that?
They get away with it because of that oligopoly power we just talked about.
Really?
Yeah. If a manufacturer wants their drug on the shelves of American pharmacies, they have to go through one of the big three. There is no other way.
Right.
So Cencora essentially dictates the terms. They deliver the drugs to the pharmacies and hospitals, and they collect payment almost immediately. But Their contracts with the drug manufacturers allow them to wait roughly 10 days before actually paying for that inventory.
So they get paid before their own bill is even due. They are effectively forcing the market to give them a perpetual multi-billion-dollar interest-free loan to fund their own operations.
That is exactly what it is. And it generates massive free cash flow.
That is brilliant.
It really is.
Yeah.
Now, to contrast them with their two main rivals, just quickly, McKesson is very heavily diversified. They are stronger in health, IT, payer, and provider software, and they actually have their own massive oncology network.
Okay, and Cardinal?
Cardinal Health, on the other hand, has very heavy exposure to medical surgical supplies. So we're talking hospital equipment, gloves, gowns, syringes.
Which sounds a lot more commoditized than, high-end gene therapies.
It definitely is. And Cardinal has faced some pretty tough operational turnaround issues because of it.
Got it.
So the final verdict on the competitive setup is that Cencora has a highly defensible, purely pharmaceutical-centric moat. They beat Cardinal Health by focusing on specialty drugs rather than commoditized hospital supplies, and they really rival McKesson's scale, but with a much tighter focus on deeply integrated joint ventures.
Which brings us to the whole question of growth. If they already control a third of a $300 billion market and they have this massive moat, how does a middleman actually keep growing?
Well, the problem with traditional distribution is that the profit margins are just razor thin. Moving boxes of branded drugs is a volume game. It's not a margin game.
Right.
They might move $100 million of a drug and only keep $1 million in actual operating profit.
Wow, that is tight.
Yeah, so their strategy is a very deliberate pivot from low-margin box moving to high-margin specialty services.
Which points right back to those MSOs, the management services organizations.
Exactly. The absolute core of their growth strategy is acquiring and scaling these MSOs. For example, they just recently made a bolt-on acquisition called iSouth to expand their specialty reach.
Okay.
By controlling the administrative backbone of these oncology and retina practices, they capture a percentage of the highly profitable services those clinics provide, well beyond just the delivery of the drug.
I think this is the crucial takeaway about their strategy. They are intentionally shedding massive, straightforward revenue streams like animal health just to double down on ultra-complex human specialty clinics. They are literally trading top-line revenue size for bottom-line profit quality.
That is the exact strategic trade-off they are making. Meanwhile, in their core U.S. distribution business, they aren't abandoning it. They are investing really heavily in AI-supported tools to automate customer service and workflow.
Just to squeeze a bit more out of it.
Exactly. Trying to get more operating leverage out of those razor-thin margins. They still expect 4 to 6% core U.S. revenue growth, largely driven by overall volume and, of course, the massive boom in GLP-1 weight loss drugs.
Oh, right. Everyone is taking those. So mathematically, what does this pivot from volume to margins spit out for the bottom line?
The financial algorithm they target for investors is a very solid 7 to 10% organic operating income growth. And because of that massive free cash flow we discussed, they supplement that growth with really aggressive capital deployment.
What does that look like in practice?
Well, according to the Q2 call, they are resuming a $1 billion share repurchase program to be completed by the end of calendar 2026. They are targeting $1.3 billion in debt paydown for fiscal year 2026, and they just maintain steady dividend payouts.
Okay, but look, no corporate strategy is completely bulletproof, right? Let's look at the execution risks. Because buying up independent oncology practices and telling doctors how to run their billing software, that just sounds incredibly difficult.
Oh, it is a massive operational execution risk. Integrating platforms like OneOncology requires harmonizing complex back-office functions across hundreds of independent-minded physicians.
Integrating these practices isn't just about installing new software. It's like trying to merge 5 different bespoke law firms into one corporate structure. Every doctor thinks their specific way of running a clinic is the only way.
Exactly. And if Cencora introduces administrative friction, or if they alienate the clinical staff in any way, those physicians will simply leave the network, and they'll take those lucrative specialty drug prescriptions right with them.
Right.
But the MSO strategy also exposes them to a risk I found fascinating in the Q2 transcript. The weather.
Wait, a pharmaceutical distributor is worried about the weather?
Yes. In the second quarter of 2026, severe inclement weather across the U.S. forced patients to cancel or delay their specialty doctor appointments.
Oh, wow.
And because Cencora's profits are now so deeply tied to the daily operations of these MSO clinics, those canceled appointments literally cost Cencora $10 million in operating income just for that quarter.
That is wild to think about. A snowstorm hits, a patient can't get to their retina clinic, and a massive supply chain giant takes a $10 million hit.
Yeah, it's a very direct correlation now.
What about the regulatory side? Because the healthcare space is always under a microscope.
The regulatory shadows are significant. First, there is the ongoing opioid litigation settlement. Cencora is on the hook for roughly $6.4 billion, which is going to be paid over 18 years.
That's a big number.
It is. It's manageable given their cash flow, but it is a constant, unavoidable drain on their capital. More pressingly, though, there is the Inflation Reduction Act, or the IRA.
Right. The new law allowing the government to negotiate drug prices. We're reporting on this subjectively, but how exactly does that policy impact the middleman?
Well, the government is negotiating and forcing reductions in the manufacturer's WAC. That's the wholesale acquisition cost, essentially the list price of the drug.
Okay.
Now, remember how distributors make money? Sometimes it is a straight percentage of that list price.
Let me do the math on that. If Cencora gets a 2% fee for distributing a $1,000 drug, they make $20. But if the government caps the price of that drug at $500, Cencora's 2% fee suddenly drops to $10, even though it costs the exact same amount of fuel and labor to put the box on the truck.
That is the exact mechanism. When the government forces list prices down, Cencora's absolute dollar margins are instantly threatened.
So what do?
They have to aggressively go back to the manufacturers and renegotiate their distribution contracts. They have to switch from a percentage-based fee to a flat fee just to protect their bottom line.
So if I'm understanding this right, their biggest risk isn't a new tech startup building warehouses, it's the government capping drug prices and massive clients like Express Scripts deciding to squeeze Cencora's margins when their contracts renew in 2029.
Precisely. The barriers to entry keep new competitors out. But the heavy hand of government regulation and the consolidation of their massive customers, those are the real existential threats to their profit pool.
Okay, if you're listening to this and wondering how all these moving parts actually translate to financial performance, let's bring it right into the present. We have the exact transcript from their Q2 2026 earnings call from May. How did they actually perform under all this pressure?
Overall, management presented it as a very solid quarter. Their adjusted earnings per share, or EPS, grew 7.5% to $4.75. Because of this, they actually raised their full-year EPS guidance to a range of $17.65 to $17.90.
But looking at the numbers from the Compascope report, there is a massive paradox here.
How so?
They raised their earnings guidance, meaning they expect to make more profit, but they actually lowered their revenue guidance. They dropped revenue expectations from 7 to 9% growth all the way down to 4 to 6%. How do you slash revenue projections that drastically but promise to take home more profit?
It all comes back to that margin mix we discussed earlier. There were three main reasons the top-line revenue dropped.
Okay, let's hear them.
First, GLP-1 drug sales are still growing. I mean, they added $1.9 billion in the quarter alone, but the rate of growth is slowing down relative to their initial really explosive models.
Makes sense.
Second, those IRA list price cuts we just broke down, those created a $2 billion revenue headwind.
$2 billion just vanished from the top line because the sticker price of the drugs went down. Wow. What was the third reason?
The third was a shift at a very large mail-order pharmacy customer. This customer transitioned from dispensing branded drugs to dispensing biosimilars much faster than Cencora anticipated.
Wait, before we go further, just quickly define biosimilar for us. Are we just talking about a generic drug, or is this something else entirely?
It is essentially a generic, but it's for complex biologic drugs. These are drugs made from living organisms, which are notoriously expensive.
Okay.
Because they are so highly complex, you can't make an exact chemical copy like you can with a generic aspirin. You make a biosimilar. They are much cheaper than the original branded biologic, which means far less top-line revenue for Cencora when they move through a mail-order pharmacy.
Okay, so if revenue guidance is down because of slower GLP-1s, IRA price caps, and the shift to cheaper biosimilars, how on earth did they raise their profit guidance?
This is the margin magic of the pharmaceutical supply chain. Those super expensive branded drugs being shipped to mail-order pharmacies. The revenue looks massive on paper, but the margin Cencora actually makes on them is incredibly thin.
Ah, I see.
So losing that specific branded revenue barely dents their actual operating profit. Meanwhile, They're layering in the high margin contributions from the MSOs, like OneOncology.
They lose the low-quality revenue, but they keep the high-quality revenue.
Exactly. And there is one more factor. It's an accounting quirk.
Okay, hit me.
Because they announced the merger of MWI Animal Health, accounting rules require them to classify it as an asset held for sale. And when an asset is held for sale, you legally stop recording depreciation and amortization expenses for it on the income statement.
Wait, so the expense just vanishes. It's an accounting illusion.
A temporary one, yes, but it instantly lowers their recorded expenses for the quarter.
Wow.
That accounting shift, combined with the real growth from the MSOs, allowed them to raise their operating income growth guidance to 12 to 14% for the year, even while total revenue actually drops.
So they are making less top-line revenue because of cheap mail-order drugs and government price caps. But they are keeping way more of the actual money because of high-end oncology clinics and an accounting rule on a division they are dumping. That is a brilliant breakdown. Was there any other noise in the quarter we should note?
Just a few transitory items. Aside from the weather impact we discussed, they had a $10 million headwind from declining COVID-19 vaccine distributions compared to the prior year.
Makes sense.
And on the leadership front, it was announced that their longtime CFO, Jim Cleary, is retiring. But honestly, the core mechanics of the business underlying all this noise, they are performing exactly as designed.
We have covered a massive amount of ground today. To close this out, let's synthesize everything into a definitive checklist for the listeners. If you are watching Cencora over the next 12 to 24 months, what are the exact keys to watch?
There are 4 critical areas to monitor. First, customer concentration. You have to keep a very close eye on the Walgreens and Express Scripts relationships. Their current contracts run through 2029. Any industry rumblings of renegotiation or any hints that these massive giants might try to build out their own internal distribution networks, those are critical red flags.
Absolutely. It's the foundation of the house analogy. What's number 2?
The regulatory environment. You have to watch how the ongoing IRA implementation unfolds. The key metric here is whether Cencora can successfully renegotiate with pharmaceutical manufacturers to switch to flat fee models.
To preserve the margin.
Right, preserving their absolute dollar margins even as the government forces the sticker prices of the drugs to fall.
So basically, can they still get paid their $20 to move the box, even if the box costs half as much? Got it. Number 3.
MSO synergies. Can they actually merge these bespoke law firms, so to speak? Can they continue to squeeze higher margins and operational efficiencies out of OneOncology and RCA without introducing administrative headaches that just alienate the doctors?
Because if the doctors leave, the margins leave.
Exactly. Their entire margin expansion strategy completely depends on the success of these physician network integrations.
And finally, number 4.
Biosimilar dynamics. This one requires understanding where the biosimilar is actually being dispensed. You want to watch the pace of biosimilar adoption in Medicare Part D versus Part B.
Break down the difference between Part D and Part B for us really quickly.
Part D is the pharmacy counter, or mail order. If biosimilar adoption accelerates there, it hurts Cencora's revenue scale because, as we saw this quarter, it strips away the high-revenue branded drugs.
Okay.
But Part B covers specialty drugs administered by a doctor inside a clinic like an infusion at an MSO. If biosimilar adoption accelerates in Part B clinics, it actually helps Cencora's profitability because they control the purchasing spread for those specific clinics.
So what does this all mean? It means this company's success relies on a fascinating, incredibly high-stakes balancing act. They have to keep massive, volume-driven retail partners like Walgreens perfectly happy, while quietly and aggressively becoming the operational backbone for bespoke, high-end specialty doctors.
And that duality raises an important question, which I think is honestly the most compelling thing to take away from this entire analysis.
What's that?
As Cencora continues to buy up the back-office operations of specialty doctors through these MSOs, they are fundamentally blurring the line between a mere logistical distributor and an actual healthcare provider.
Right, because if you control the doctor's billing, their scheduling, their clinical trial access, and their supply chain, you are effectively running the clinic.
Exactly. At what point does the invisible middleman simply become the healthcare system itself? And how will regulators, and the payers footing the bill, respond when one massive entity controls both the physical supply of the most expensive drugs on earth and the daily business operations of the doctors prescribing them?
That is a phenomenal puzzle to leave you with. Next time you pick up a prescription or read about a breakthrough gene therapy, remember the invisible plumbing. and the $300 billion flowing through it, making it all happen. Thank you for joining us on this deep dive, and we encourage you to keep looking beneath the surface of the markets.
This content is produced by Compasscope.com. For more than 1,100 public-listed companies, find detailed company research reports, visual mind maps, earnings call analysis, and audio discussions on Compasscope.com.